Welcome to the Global War Watch Network. China's Belt and Road Initiative. Well, it was once hailed as maybe the most ambitious infrastructure project in history. But now you hear about mounting debt, failed projects, and growing global pushback. It's raising a serious question: is the BRI collapsing under its own weight? Today, we're going to try and untangle this massive global story for you, looking at the evidence, the shifting strategies, and, what it all means for the world. When we talk about China's Belt and Road Initiative, or BRI, we're discussing something truly monumental, aren't we?
Absolutely monumental.
Launched back in 2013, it's dramatically reshaped global infrastructure financing and investment, promoting what many call a China-centered model of development. We're talking over 150 countries, investments already past $1 trillion. The sources we've looked at lay out, well, a fascinating picture of its journey, its early promise, its challenges, and maybe its surprising resilience.
Yeah, what's particularly striking, I think, is how the narrative around the BRI has evolved. It started really as Beijing's going out strategy, essentially. A government push for Chinese companies to invest overseas. Part of it was leveraging domestic industrial overcapacity, diversifying foreign assets, but then it grew. It became this powerful brand for much broader economic and strategic ambitions.
Right.
So we'll explore that initial grand vision, the significant criticisms that followed pretty quickly, and the very substantial shifts China is making now to adapt. Which brings us right back to that core question. Is it truly collapsing, or is it actually transforming into something new?
Okay, building on that, let's unpack this initial appeal. BRI really captured global attention, didn't it?
It really did.
It filled this huge void left by traditional international financial institutions. They kind of moved away from funding those big, hard infrastructure projects for a while. But almost from the very beginning, concerns started popping up.
Indeed. What we often saw was projects leading to pretty substantial financial obligations for the countries involved. It created a new kind of financial dependence on China, really. And critics, particularly from the U.S., quickly came up with the term debt trap diplomacy.
Ah, yes, the debt trap.
Exactly. The idea being that China extends these, often opaque loans, sometimes excessive ones, to low-income countries. These countries then struggle to repay, and ultimately they're forced to perhaps cede strategic assets or influence to China.
And the most prominent example, the one everyone points to, mentioned clearly in our sources, is the Hambantota port in Sri Lanka. Can you walk us through what happened there? Why did it become such a flashpoint?
Sure. So back in 2017, Sri Lanka was facing a really dire financial situation, couldn't manage its debts effectively. They made this significant decision. They leased a 70% stake in Hambantota port to a Chinese state-owned enterprise, China Merchants Port Holdings. And it was for 99 years.
99 years, wow.
Yeah, a long time. In return, they got $1.12 billion. Right. But here's the crucial part, and this is important to understand. This wasn't debt cancellation. That money was used for foreign reserves, paying off other short-term debts. It didn't actually eliminate the original Chinese loans used to build the port in the first place.
Ah, I see.
So this raised huge concerns about Sri Lanka's sovereignty. And it really highlighted China's preference, often, to extend or renegotiate loans, keeping that influence, rather than just forgiving the debt.
Okay, so if it wasn't just about getting immediate debt relief, that suggests a much deeper geopolitical angle, right? Is this really just economics, or is China systematically acquiring strategic footholds?
That's a really crucial distinction. Hambantota Port, its location in the Indian Ocean is incredibly strategic. It's not just a commercial asset.
Right.
It fits into China's broader strategy to secure critical trade and energy routes. Our sources show that, as of September 2023, China had active investments in 101 port projects globally, and 10 of those are strategically placed around the Indo-Pacific. Now, these could potentially be used for naval purposes. That adds a whole security dimension to what look like purely economic deals.
Sri Lanka is a stark example, but the sources indicate these vulnerabilities, these strategic implications, they go much further, especially into Central Asia, where China's influence seems to be growing exponentially. What's the picture there?
Yeah, in Central Asia, China has, undeniably become the main economic and trading partner for many countries. The region's collective debt to China hit about US $15.7 billion by mid-2023. That's substantial. And countries like Kyrgyzstan and Tajikistan are particularly vulnerable. Their debts to China are around 40% and 27% of their total GDPs, respectively.
That's huge.
It is, and the concern is clear. If they struggle with repayment, China could potentially gain control over key infrastructure. Maybe Kyrgyzstan's main thermal power plant or Tajikistan's gold and silver mines. That leads to a very strong, maybe inescapable dependence.
This brings up a natural question for listeners. How does China's approach to lending, particularly around debt relief, stack up against traditional institutions like the World Bank or IMF?
Yeah, it's a key difference. Unlike, say, the World Bank and the IMF, which have shown, a greater willingness sometimes to forgive debt for the poorest, most indebted countries,
Yeah.
China has generally favored extending loan terms or renegotiating.
Okay.
Now, that strategy lets them maintain or even increase their economic and political leverage over these nations. And add to that the persistent lack of transparency in many Chinese loan agreements. In some countries, unfortunately, that's made problems with corruption even worse. It adds another tricky layer.
It is important to note, though, as our sources do, that not everyone sees this negatively.
That's true.
Some leaders, some experts in Central Asia, for example, dismiss these debt trap concerns as just Western propaganda. They see borrowing and repayment as, well, just a normal part of economic interdependence with a major power like China. It really shows the multiple perspectives involved here.
Definitely multiple angles on this.
So moving on from those early challenges, the financial strains, what's fascinating now is how the sources indicate that BRI is entering a new phase in 2025, a recalibrated phase, shaped by things like climate demands, debt rebalancing, digital expansion, geopolitical shifts. It really does sound like a BRI 2.0, doesn't it?
Absolutely. BRI 2.0 is a good way to put it. China is clearly adapting its strategy. Remember President Xi Jinping's 2021 pledge to stop funding overseas coal? Well, since then, there's been a noticeable shift towards sustainability.
Okay.
Sources show over 65% of new BRI energy projects are now focused on renewables, solar, wind, hydropower. And crucially, ESG reporting, that's environmental, social governance reporting, showing how companies perform on those non-financial factors, that's now mandatory for major contracts.
That's significant.
It is. Though it's worth mentioning, those legacy coal and oil investments from the earlier days, they still exist in some places.
That sounds like a positive shift on the green front. But what about the elephant in the room, the debt? What's changing financially to address those debt trap worries?
Well, China did restructure or suspend over $78 billion in loans across 2023-2024. So that shows some flexibility. We're also seeing more public-private partnerships, PPPs, which can reduce the state debt burden for recipient countries. There's even talk of debt-for-nature swaps in Africa and Asia, where debt is forgiven if a country commits to conservation efforts. The overall focus seems to be shifting towards smaller-scale, more locally rooted projects, moving away from those huge, sometimes symbolic mega projects.
Right.
The aim seems to be more mutually beneficial outcomes, though transparency, even in these new structures, it remains an ongoing concern for many observers.
And beyond the physical stuff, the roads and ports, there's this whole digital Silk Road emerging too. How's that developing?
Well, it's a huge part of the evolution. Chinese companies are building 5G networks in over 60 countries now. They're exporting smart city tech, surveillance tech, and launching satellite networks like Beidou, that's China's own GPS rival.
Right, Beidou.
This tech dominance definitely offers connectivity benefits, but naturally it raises big questions about data sovereignty, cybersecurity, who controls the data.
So putting all this together, what does it mean for the types of projects we're actually seeing on the ground now? Is it still just about massive new highways?
It's definitely different now. BRI 2.0 seems less about grand symbols, more about sustaining what's there, integrating it, and localizing the benefits. China's diversifying. They're getting into infrastructure maintenance, upgrades, logistics parks, cross-border e-commerce, health infrastructure, even education partnerships.
Interesting.
And it's becoming more regionally adaptive. They're tying projects to local plans like the FCFTA, the big free trade area in Africa, or linking up with ASEAN master plans in Southeast Asia.
Given this shift, this adaptation, what do you make of the selective engagement we're seeing, even from countries that were pretty wary before, like Italy or Malaysia? Does it signal real strategic diversification, or is it just China pulling back temporarily?
I think it strongly suggests strategic diversification, not a retreat. China is showing flexibility, pragmatism. Countries that maybe had reservations or even pulled back are now re-engaging selectively. They're picking projects that align with their own interests.
Makes sense.
It shows China can adjust its offerings to stay relevant, to remain an attractive partner, and that's absolutely crucial for the initiative's long-term survival.
Now, to counter this Chinese model, the U.S. and its allies are trying to step up. The U.S. International Development Finance Corporation, the DFC, often comes up here. How is their approach different?
The DFC operates on well, fundamentally different principles. Unlike the big Chinese state lenders, it mainly supports private sector projects.
Wow.
And it explicitly prioritizes things like transparency, rule of law, sustainable economic models. For instance, the DFC committed $500 million for the West Container Terminal in Sri Lanka's Port of Colombo. That project isn't just about building something. It's expected to boost Sri Lanka's GDP, sustain thousands of jobs, and importantly, do it without creating those debt traps or needing constant appeals back to Washington.
That sounds like a compelling alternative, focused on values, transparency. But can it realistically compete? I mean, the sheer scale and speed of China's investments are hard to match. Are Western initiatives like the DFC or the EU's Global Gateway really equipped to offer a consistent, competitive alternative, especially given their different risk appetites?
That's the multi-billion-dollar question, isn't it? Western competitors like the EU's Global Gateway, the US-led PGII, they're pushing for open, ethical frameworks, sustainable development. Japan's also been a quiet leader offering alternatives. But the ability of the US and allies to maintain a consistent approach, that's the challenge, especially when political priorities shift back home. As one source put it, if a development finance institution changes its main focus every few years with a new government, it's really hard to build that long-term trust and continuity that developing countries need.
Okay, so just when you might think BRI is settling down, maybe becoming small but beautiful, as Xi Jinping once said. Our sources, Griffith University in Australia, the Green Finance and Development Center in Beijing, they reveal this stunning reversal in the first half of 2025. This really turns the narrative upside down. What did they find?
It's truly astonishing. The first 6 months of 2025 saw the highest level of DRI engagement for any 6-month period since the whole thing started.
Higher than ever.
Higher than ever. We're talking $66.2 billion in new construction contracts, $57.1 billion in investment. Add that up, it's more than the entire year of 2024 combined.
Whoa.
It's a massive, unexpected surge.
That's incredible. So where is all this money suddenly going? Which sectors, which regions?
It's highly concentrated. Energy-related deals hit an amazing $42 billion. That's double the previous year. Within that, oil and gas engagement hit a record $44 billion. But interestingly, green energy also hit new records, $9.7 billion for wind, solar, waste-to-energy.
So a mix.
A mix, but heavily weighted towards resources. Metals and mining also surpassed 2024 figures already, regionally. Strong activity in Africa, often driven by these huge resource-backed deals. The Middle East remains central. Central Asia has seen an explosion of activity, especially new mega deals in Kazakhstan. Southeast Asia is still important, it's right there, but Latin America, it continues to see low Chinese engagement, lowest in a decade for both investment and construction among BRI countries.
So this huge surge, is it a return to the old style of big, potentially risky projects? Or is it something new driving this?
It seems to be a different kind of project, a more strategic one. The focus is moving away from, say, public infrastructure that doesn't generate its own revenue directly, like maybe a road built just for social good.
Yeah.
Instead, we're seeing a lot of these resource-backed mega deals. Like there's a $20 billion project in Nigeria for a gas park. The idea there is that exploiting and selling the gas itself generates enough cash flow to directly repay the loans and the contractors.
Ah, self-financing in a way.
Exactly. It's not just about building anymore. It's about building projects designed for immediate self-sustaining cash flow. That's a very smart evolution of their model. And it's not just about repayment, you see. It's a strategic pivot. It's about securing vital resources for China's own economy.
Right.
So BRI shifts from just building connectivity to actively securing critical supply chains. That fundamentally changes the game for global resource access and potentially increases partner nations' reliance on China as their main market.
That's a powerful financial model. Who are the key players driving this surge, though? Is it still mostly the big Chinese state-owned enterprises, or are private companies getting more involved?
Well, state-backed financing is definitely still a big part of it, no question. But what's really notable now is the increased activity of private Chinese companies. We're seeing firms in mining like Zijin Mining or in technology like CATL, the big battery maker, and EV parts suppliers. And in metals processing like East Hope Group, they're making very significant investments abroad.
Interesting.
And these private companies often leverage government support like export credits or insurance, much like Western governments support their own companies overseas. This mix of state and private actors gives the BRI a broader, probably more resilient base now.
Matthias Knudsen, a global procurement strategist mentioned in the sources, called this evolution a critical turning point. He stressed success depends on shared ownership, adaptability, transparency. What stood out for you from his insights on this new phase?
His point about local capacity building really resonates. Helping countries reduce dependency over time, and the need for stronger sustainability metrics. He warns that these global projects have to evolve to deliver real equity, resilience, and respect local agency, not just impose solutions from outside.
Yeah.
But what's particularly powerful, I think, is his observation about China's consistency. Even in really difficult business environments, places where Western companies might hesitate because of perceived risk or shorter investment horizons, China often stays the course. They've built up immense experience, a track record of actually delivering projects, and that leads many BRI countries to see them as reliable, long-term partners. That's a huge advantage.
Consistency is key. So, wrapping this up, what does this all mean for you listening in as we navigate this incredibly complex global picture? China's Belt and Road Initiative, well, it's clearly not collapsing.
Not at all.
Instead, it's transforming. It's becoming more targeted, more financially savvy, and surprisingly, surging in scale again in these key sectors. It's a really nuanced story of adaptation, ambition, and the shifting geopolitics of global infrastructure. It's reshaping our world as we speak.
Yeah, the future of the BRI, it's going to hinge on how China keeps responding to criticism, how it builds genuine trust, and whether it can truly co-create futures with its partners, not just for them, by connecting cities. And the challenge for other global players, it remains offering consistent, competitive, and genuinely sustainable alternatives. Alternatives that uphold their own values while meeting the very real, very large infrastructure needs of emerging economies.
And here's something to consider. As the BRI continues this strategic diversification, focusing so heavily now on these cash-generating projects and critical resources, what's the long-term impact going to be on global supply chains? And on the economic sovereignty of the nations involved, especially if Western engagement continues to fluctuate? Thank you for tuning in and participating in this exploration of the Belt and Road Initiative. We really do appreciate your time and engagement.
Yes, thank you. And if you found this discussion insightful, please do remember to like, share, and subscribe to the Global War Watch Network. Your support genuinely helps us continue to bring you these analyses.
We'd also love to hear your thoughts on today's discussion. Please share your perspectives down in the comment section below. And join us on social media. All the links you need are provided right there in the description.